The key thing for investors to understand is these international businesses, you do well if you break even in 5 years. The true payback is really beyond 10 years. If self-driving cars were going to become the near-term threat that we thought it could turn out to be, it could shrink the car insurance market. We had a scan of the globe. We chose Australia and we think it was a really great choice. Short-term insurance, it really depends on the size of your middle class. I mean, South Africa has got 12 odd million vehicles, but only a third of them are insured.
It's quite famous in the JSE how hard it is for South African companies to replicate their business models offshore, and it's probably only a single, maybe not even a single handful of companies that has done this as well as OUTsurance has. Is there anything other than what you've touched on already that you think helped you succeed where others have failed? Hello and welcome everyone. This is Building Conviction, a podcast about what it takes to build something exceptional. The businesses, the leaders and the decisions behind them, and the conviction to back them for the long run. My guest today is Marthinus Visser. Marthinus joined OUTsurance in 1998 as a young actuary, the year it was founded on a simple promise: you always get something out. And he's run the group as CEO since 2018. He's seen all of it. The business has grown from a single Centurion office into a multinational insurer spanning South Africa, Australia and Ireland, today worth more than 100 billion rand on the JSE. So Marthinus, I thought to start it might be good to go all the way back to 1998. Tell us a bit about how OUTsurance looked the first day you walked into the office.
Yeah, so maybe to give you a bit of history how it came about that I ended here, I think it's an interesting story. I mean, you would know yourself, if you study actuarial science, I mean, you don't really have a clue what it is. I mean, some of your aunties will ask you explain what it is, and you actually, I mean, I actually still find it difficult. But point is, I mean, I didn't have that much of a clue, but I had a bursary with a life insurance company, and I did holiday work in pensions and life. But at the same time, at least at Tux, we got exposure to short-term insurance quite early on. And I mean, through that exposure, I realized that I'm much more interested in short-term insurance. I think sort of two things. The one is you just have so much more data. And the other thing is the feedback loop is much faster. I think with life insurance, your kids will figure out whether your models were right or wrong. With short-term insurance, you figure it out within a few months. So that really played a role. And then sort of a month before I had to start with this life insurer, another short-term insurer contacted me and said, but listen, would I be interested? And it was an easy decision. And I then jumped to this short-term insurer and I got great exposure. I mean, that was just the time when Joel Ems came in and I got really great exposure. I even worked overseas for them on very big data sets. So that was very beneficial. And then sort of 18 months later, OUTsurance contacted me and they made me an offer. And again, it was an easy decision for two reasons. One being a direct business, so your data is just so much better. But the other one was it being a startup. I mean, you plug in at a much more senior level where you see the whole business and you also have much more influence. I mean, one person I asked said, "Oh, you're going to get a name as a job hopper." But I guess 28 years later now, I sort of I got rid of that tag. And yes, when I arrived at OUTsurance then in '98, a few months after they launched, I mean, what I found here was really a company, sort of 100 people. It had a great culture. It had great systems, very good data structures, but a poor loss ratio. Now, if you're a young actuary wanting to make a difference, you can't dream of anything better than that. Just the right place to make a difference. And I really enjoyed those first few years because the place is so small, you can really see the impact of the things you're doing quite quickly.
Yeah. And tell me, was there anything like you saw in that first month or two that almost could have been a foreshadowing that this business could be 100 billion rand like 25 years or so later?
No, I don't think we were so focused on getting to break even. I mean, sort of the interim goals, and yeah, I mean we reached break even within 24 months after that. It was a bit of a special case because I mean it depends a lot the scale you need on the relationship between your average premium or revenue per client and your overheads. And just because you had such a young executive team, and also the regulatory environment was different, that relationship was very different to what it was now. So you didn't need that much scale. So we were able to achieve break even within 2 years. But yeah, it took a lot of focus and a lot of quick changes. The feedback loop was just incredible.
I mean, you just mentioned that you were attracted to the fact that it was a startup business. I mean, my sense is that most actuaries won't be attracted to that. So I'm wondering, was there anything in your youth or while growing up that you think specifically attracted you to this kind of business, or maybe that helped prepare you for effectively the role you got to now?
Yeah, it's interesting. I wasn't the first choice. You're absolutely right. So a few actuaries declined it. So I wasn't the first choice. But Willem actually knew of me. But I was working sort of for someone who he knew, and he didn't want to sort of interfere there.
Okay.
But eventually a headhunter solved that problem. But yeah, I mean, I read up a bit about direct insurers because, I mean, it was more common overseas, and just understanding and seeing the potential and the data. I just thought that this thing has got legs. And I was really excited about that. I think what also helped a bit was I'm quite a petrolhead. I love cars. And the fact that you can sort of find this overlap between that passion and the business was very beneficial, because part of the problems around those early days was we were writing the wrong cars, and certain cars were getting stolen. And if you understand all of those details, it was quite important.
Brilliant. And I mean, maybe tell us a bit about the market at that stage, like who were the major players and why do you think it was ready for a business, for OUTsurance to succeed at that point in time?
It was, South African market was almost exclusively still broker based, but there was one direct insurer, but it was more small scale. Now, I really think it took sort of another player with a bolder approach and more focus to give impetus to that direct movement. And shortly after us, a few more direct players launched, and sort of two of them failed, and I think then the market pulled back. But then after we had quite a lot of success, sort of a second wave of new entrants came, and most of them were sort of linked to bigger financial services groups. As such, they had good backing, and most of them are still around. So at the moment, we estimate new business in personal lines is probably close to 50-50 between direct and face-to-face in South Africa.
And at that time, almost purely intermediate, I guess, eh?
That's right.
So Marthinus, I'd love to hear the story of the OUTbonus and where that came about. I mean, it's such a key part of the OUTsurance story, and then also how it worked out versus what was imagined at the start.
As you know, I mean, back in the day, insurance was very much a grudge purchase, I guess, even today still. But I mean, the thinking at the time was, I mean, everyone said you only get something out if you claimed. And we wanted to turn that onto its head. And we came out with the OUTbonus, which basically said you get something out whether you claim or not, i.e. you always get something out. Also at the same time, we wanted to sort of address some of the other common gripes in the market, because cars were typically covered for market value, and then if you have a total loss, there's that shortfall. So we started to cover the cars at retail value. Also, most products had a lot of percentage excesses, which made it quite difficult to understand and also caused some shortfalls. So we came out with flat excesses. Also, the policy wordings was quite legalistic jargon, and we tried to come out with a wording that was really plain language. So those were the things we tried to sort of just differentiate ourselves a bit from a product perspective. Although at the end of the day, I mean, premiums or price and service and those things matter a lot. So, I mean, how did it turn out? I think very much in line with expectation. And I think that's also the reason why when we now launched in Ireland, we always also went with the OUTsurance brand and with the OUTbonus. And what is exciting is that next year we'll be starting to paying the first OUTbonus in Ireland. And it should be interesting to see what sort of reaction we get from that.
Yeah. I mean, you also just mentioned that the loss ratio was quite high when you came in. What were the early contributions you made to the business? Was that a key part of it, or any other areas you were specifically involved in that you can remember?
Yeah, I think that's the fantastic thing, being such a small company, and also sort of the culture we have for actuaries to get involved in the entire business, not to sit in a corner office and get pizzas under your door and you just do reserving and pricing. I mean, it's important to understand the entire business. So I really got involved in everything where you give input on even though there's not formal reporting lines, you're able to give input on all the aspects, because in the end the business is data driven, and actuaries are quite well equipped to understand data. And yeah, I think so that's an important point.
Part of the success for me of any great business is having great people. And I think over the years I've interacted with various senior people in OUTsurance, and it does strike me that people really are exceptional, believe in kind of what the company's building. What do you think you can ascribe that to, the ability to attract and also seemingly retain these great people for a long period of time?
Yeah, it's critical. I mean, getting the best people. I mean, I think that it starts at the funnel and the approach. You should never be afraid to appoint people who are smarter than you. I think that's a key thing. Always go for the best possible person you can get. I think that's really critical. And then you must create the right environment for them to develop them and retain them. I think the culture is critical, that it's a nice working environment, but you have the right culture. I also think, I mean, we have an owner-manager culture, which is really important. If you look at the successful companies, it's really compounded. I mean, if you look at how many were started since mid-90s until now, there's not many standing out, but all of them have that sort of owner-manager culture. And what it brings long-term thinking, which I really think is critical given the length of the J-curves of these businesses that we started, and we can elaborate a bit more on that just now. And also just, I mean, you think like an owner, you spend the company's money as if it's your own. And I mean, in a business that's quite cost sensitive, I mean, that's quite critical. So creating minority shareholders, I think, is really key for the business, over and above the normal good things like a great working environment, upward mobility, a great culture, and those things.
I mean, how have you been able to hang on to that owner-manager culture as the business has grown larger? I mean, it's easier at the start, but now you're many thousands of people. So, I mean, what's been the key things to hang on to that spirit?
Yeah, you have to be deliberate about it, because you do get a lot more you become more corporate as you get bigger and bigger, and you need to fight that and consciously work on that and call it out and try and remain as nimble as possible and make sure people are a culture fit. Because, I mean, if someone walks in here, I mean, I'm dressed as formal as you'll ever see me. If someone walks in here and they rather want to wear suits and that, I mean, we take ourselves not too seriously, but we take our job seriously. And I think that culture fit is important. If someone walks in here, someone who wants to work hard, but also have a balanced life. I mean, that's the typical people we employ. But I mean, we don't like political people or corporate people or bureaucrats or things like that. They just don't work here. And we figure it quickly out, and they figure it out. And it's best for all parties that you align that way.
So let's move on to Youi, that you guys started in 2008. So it's quite early, 10 years in to go after a big new country. I mean, take us back to that time, some of the key things that went into that decision.
Yeah, the South African market for short-term insurance isn't that large. And I mean, once we reached break even, we grew quite fast. And we got sort of in our segment of the market up to sort of 10%. And when we asked ourselves, listen, are we going to diversify into different financial services, or are we going to focus on our core strength, short-term insurance? And we had a scan sort of the globe, and we ended up with 2 countries being Brazil and Australia. And in the end, we chose Australia, and we think it was a really great choice. Yes, I mean, Youi really provided sort of a second wave of growth to our business. And also, I mean, that market is much larger than the South African market. I don't think everyone realizes, but that market is 4 or 5 times the size of the South African market, because short-term insurance really depends on the size of your middle class. So even though their population is 27 million, South Africa is probably 63. Their middle class is 4 or 5 times our middle class, I think, and that's what's driving it. Because, I mean, South Africa has got 12 odd million vehicles, but only a third of them are insured, whereas they've got sort of 19 million vehicles, and they're pretty much all insured.
And I mean, tell me about some of the early obstacles you guys had to face there, and especially maybe things that was different from SA. I mean, you obviously had this SA playbook by then that had already worked very well. I'm sure some of that worked, but was there some things that you had to do quite differently to succeed there?
Yeah, I mean, we deliberately choose markets that are as similar as possible to South Africa, because that allows you to apply your core strengths in your model. So if things is like Venus and Mars, then something turned out wrong. So I think a key challenge was just to assemble the right team, that you have strong people in all the key positions, and you must get through those early days, because, as I said, even with OUTsurance, day 1 you have 0 data. So your pricing and underwriting in the beginning is a lot of judgment, and sort of deriving things from your other country or from your past memory and things like that. So getting through that period, preventing anti-selection, until you sort of found your feet on the pricing and the underwriting, and then you can scale it up. So I think those were the main challenges. But the key thing for investors to understand is these international businesses. I mean, it's while the J curve is, I mean, you do well if you break even in 5 years. The true payback is really beyond 10 years. That's really when you become established, your cost ratios become competitive, the brand is there. But then if you look at OUTsurance since 1998, I mean, our compound growth rate, excluding dividends, is just over 29%. So that's a strong compound growth rate, and that's only made possible by these successful startups. But they do take quite a long time. You really need to be patient with them.
It's quite famous in the JSE how hard it is for South African companies to replicate their business models offshore, and it's probably only a single, maybe not even a single handful of companies that has done this as well as OUTsurance has. Is there anything other than what you've touched on already that you think helped you succeed where others have failed?
Yes, I think so. I think sometimes it's so critical that you choose the right country, and whereas Australia might be good for insurance, it may be poor for retail. You need to understand what's your model and why it's going to be the right country for you. Because I think some companies choose the wrong country for the wrong reasons. I mean, some companies might choose a country with a very large population because they say, listen, I need to move the dial relative to my own business or market. Others might choose a country because there's an M&A opportunity in that country. Others might choose a country because the executives want to stay there. Those are the wrong reasons. As I said, you must choose a country where you can apply your sort of core strengths and your recipe. I mean, some great international insurers have failed to expand internationally because they chose big markets and they assumed they can change those markets to work the way they work or their home market work. And I think that is a long shot for you as a company. Consumer behavior and those things are driven by different things. You have legislation, tradition, culture, and lots of things. And often it's very hard to change it for a single company, especially a single foreign company to change that. So I think that is critical. And then also, I mean, just our thinking in terms of buying a company versus starting greenfields and growing organically. The issue in insurance, I mean, you buy a company. Now you don't have the right people, the right system, or the right clients. So you can't change that without destroying most of what you've paid for. And that's why we'd much rather start greenfields. We have the right systems, data structures, people, culture in place from day one and grow it organically from there. But it's important. You must just have a long time horizon for that.
I guess a very deliberate selection of the country and spending a lot of time on getting that right.
Absolutely.
And then obviously executing afterwards. But yes.
And I mean, it's not as if we have to expand. If we don't get an appropriate country, we're going to say, listen, let's rather just pay the dividends, because there's no country that's ticking all the boxes.
Yeah. If you look back at Youi's history, are there one or two key decisions points you can think of either earlier on or maybe later on that made a big difference to the very successful outcome we've seen now?
Yeah, there has been key decision points. I mean, all of them I can't share, but some of them might be competitive. But I do think, again, leadership and succession is really important. I mean, we've seen if you have unsuccessful succession now, it can set you back. And I mean, that's also why it's so critical for us as a business. We focus on internal succession, that you make sure you have a pipeline of people that you develop, who understand the business and the culture. I think that's really, if I had to single out one critical thing, it's getting that right.
Then, I mean, you took over as Group CEO in 2018, but obviously at that stage you'd been with the group for 20 years. I'm interested, did you have to almost step back and look differently at some parts of the things to be successful in the CEO role versus your previous role?
I was quite close to the strategy in my role. So that part I understood quite well. But the process of executing on it, I think that is where you need some development in your leadership style and teamwork and those things. I think that was where it presented a new challenge, and it was great. I mean, you always have to challenge yourself, and as that's the way you learn. I mean, when I became CEO, I sort of had 5 goals that I set, and the first was to clarify the strategy, because at the time we experimented a bit. Just to give you context, so we had good clarity when we started Youi. Then sort of when Youi's growth slowed down, we had a look around the world again, and we couldn't find another market that ticked all the boxes at the time. And at that same time, we were also quite concerned about self-driving cars. And because of that, we thought, listen, instead of now going into another country, we must rather diversify a bit out of motor insurance, because if self-driving cars were going to become the near-term threat that we thought it could turn out to be, it could shrink the car insurance market. So we actually diversified into a lot of other financial services at the time. But the reality is, as we progressed with those, we realized the further those things were from our core, the less well they did. And also, what I also came to learn was, I think we prematurely hit the ceiling in some of our businesses just because of execution that wasn't good enough, rather than that the opportunity was saturated. So my first sort of objective was to clarify that strategy again, to get some focus into the strategy. The second one was to revitalize the top line growth, because we were sort of at a bit of a standstill in 2017-18. The third one was to ensure strong top line to bottom line conversion through all the units, which was quite important. The fourth one was to get our system modernization really on track, because we've always had great systems, but after 20 years it was time to re-platform, and it's quite a big process, and it's critical for our success. And the fifth one was succession, because we just had that incorrect succession at Youi, and to sort it out and to make sure we get good succession in all the relevant areas. Yeah, and if I look back at it now, I think we've made really good progress in all 5 of those areas so far. But yeah, I've enjoyed the journey a lot. It challenges you a lot. It's long hours working across 3 jurisdictions, hard work, but yeah, it's really rewarding.
I must say, specifically what stood out from an external investor's perspective is the re-acceleration of top line. That really, I'm assuming you planted the seeds early on, and the last 5 years has just been very clearly visible. I mean, maybe talk through 1 or 2 of the key things that went into achieving that, because it was just a real standout feature for me.
Yeah, I think it's just focus and execution. I mean, a lot has been said about execution, and there's many recipes, but that's really what it boils down to do the right things, and yeah, it adds up, and the business is really performing well. How we revitalize that sort of organic growth, and I think once you stop worrying about other opportunities and things and bring it in, that really helped a great deal. But then you also build confidence as you see you're starting to get some wins. I mean, that really helps.
I mean, OUTsurance also seems particularly ambitious to me for a large company still. So, I mean, anything you've done to almost maintain that ambition and drive in the business, even with all the success it's had?
Yes, I think that's part of our culture. That's part of that owner-manager culture that definitely drives it. It's also part of the good succession that we bring in, fresh legs, maybe also a bit like the Springboks, that you have a good mix between the old hands, the experience, but some fresh legs, and yeah, and I think the international expansion certainly gave the business an absolute new lease of life. And if I can use that analogy again, because you guys also deal with the rugby, but I mean, it's a bit like starting to play internationally. You get exposed to different conditions, different fields, different referees, different opponents. I mean, suddenly you need to solve problems which you haven't had to solve before, but by learning how to solve them, you become a better player. And I think just by working across these jurisdictions has made us a better business. And we don't operate in silos as like 3 separate businesses and we just invest in it. It's run like sort of one business, and all the key learnings and understandings is sort of we understand centrally.
And how do you, I mean, just thinking about that, like typically your offshore teams, are there some South Africans as part of those teams typically to help the culture fit with the business here?
Absolutely. Yeah, I mean, if you look at the senior management across Australia and Ireland, many of them have been recruited through the actuarial program in South Africa.
Marthinus, you mentioned earlier just the spectacular rate of compounding you've seen since inception. I think it's really it must be probably the best, one of the very best on the JSE, one of the best we've ever seen. If we try to think about the competitive advantage or moat of the business that's enabled that, is there a few key things you can speak about that's driven that consistent compounding and high returns?
Yeah, I think people often speak about a brand as one of the things that's a key part of your moat, and it's important. But then again, I mean, as we mentioned earlier, I think your people, your culture, and then your computer systems and your data. It's the world we live in. Those things are key. And I think if you can have those sort of 5 things intact, I mean, look at a Progressive in the US. I mean, they've, over the last 24 years, I think their market share went from 5% to 17% in the most competitive market in the world. And they recently accelerated their growth even a little bit. So they're well on track to get to 20%. So I do think if you get those things right, you can compound for a very, very long time. But again, it takes patience. I'm talking about 24 years, sort of adding 0.5% market share every year. But if you convert that 0.5% from Progressive into units, you actually see it staggering unit growth that they're achieving. So it is definitely possible if you keep the focus on those things.
Yeah, it does seem that there's something to the model that leads to compounding growth even as the business gets larger. And if I look at your Australian growth rates, they're as high or higher now than they were 10 years ago, which does say something about how it works.
Yeah, and we're excited about the short-term insurance industry. We're really excited about its prospects. And maybe I can touch on it. I mean, we spoke about self-driving cars earlier, and so we were quite concerned about it. But I mean, it obviously became apparent that they're on a slower development path than what we thought. And as such, we were comfortable to grow and focus on car insurance again. If you look at the latest data, then I think sort of in terms of robo-taxis, you see, I mean, a lot of progress has been made in controlled environment. But in the absolutely uncontrolled environment, I mean, there are still a few problems to solve. Now, as tech goes, we think it will be solved over time. But I mean, if you look at the latest studies, I mean, most of them sort of have consensus that we're still in for a few years of real growth in car insurance, where the additional expensive technology actually increase average claim cost more than what they reduce frequency, with a net effect with some still a bit of real growth. But then at some point you get a tipping point where you actually start to see the frequency coming down faster than those average cost increases. However, we see significant real growth in non-motor insurance, and we actually expect non-motor to pick up that slack for motor insurance. So we don't see the market in aggregate shrinking. And I mean, some of the drivers in that non-motor space is things like climate change, urbanization, and expensive technology being fitted to houses. I mean, you just look at the storms we're getting. I mean, just recently in the Western Cape, we've had storms in Perth, we had storms in Queensland earlier in the financial year. I mean, when you get big hailstorms, I mean, it's staggering how much the solar add to those storms. Now, solar is a great technology. I mean, it's technology that must be used. It makes absolute sense, but it must be insured. And we stand ready to insure it. So that's why we don't see this completely contracting market. We just see a world where the mix between motor and non-motor over time, as self-driving car technology gets better, that mix might shift a little. You might also start to get new types of cover. For example, cyber cover on a more granular scale than the typical cyber people see at the moment. So yeah, we're very excited about that. The other thing which also talks to that compounding, which you referred to earlier, is also, I don't think it's a very sexy industry. And it's just highly regulated, and it becomes even more and more regulated. So in the markets where we enter, we find out we're like the first company to have entered in the last 10, 15, 20 years, and also the last one. Yes, I mean, you get some partnerships, some brokerages and distribution partnerships, but a fully fledged underwriting company, that is rare, because the entry barriers have just become so high. And that's why we see in most markets even more consolidation, where you because of capital requirements and regulatory requirements, it's very difficult for a very small insurer. And with that consolidation, it creates opportunities to grow organically. You end up having fewer competitors, and you can compound. And that's why we're so optimistic about the future.
Okay, so having a long-term belief in the industry, really, in your industry, really is an edge versus people that might want to hedge their bets or not just bet on it.
Absolutely.
I also thought it's interesting looking from the outside in how you've been willing to try things, but then also cut the things that didn't work. Like I'm thinking OUTvest and maybe New Zealand, for example. I'd be interested in your thought process around how making those decisions, and potentially, if you're interested, also speak about something like a New Zealand or something, and what the difference was there versus Australia or an island you're going after now.
Yeah, I think some of those experiments was obviously part of that strategy to diversify. And in hindsight, what we learned, if you're world class in tennis, you're not necessarily world class in squash. Sinner or Alcaraz is not going to walk onto the court and become the world squash champions. So I do think we have now much more conviction to focus on our core strength, and we've unlocked so much runway in our core markets now. I mean, you think about OUTsurance in a commercial market in South Africa, we lots of runway. In terms of face-to-face, I mentioned earlier that 50% of the business in South Africa is still face-to-face. So there's an opportunity for both personal lines and commercial face-to-face with our agents or out brokers, as we call them in South Africa. Youi Direct, if you look at our current market share, there's still loads of runway for Youi Direct, and also for Youi in the direct small commercial, and then obviously in Ireland. So significant runway in our core area, which excites us. But we're still open for experiments. I think the key thing is, as you say, you must have capital discipline to cut it and face the brutal facts. If something is not working, you need to be able to cut it. And I think another important one is don't bet the farm. We've never bet the farm in that it could sort of jeopardize the whole group's well-being. I mean, I think a lot of the time people think these greenfield startups are high risk, but if you do the math, it's really, you need to worry about the accumulated loss, not about the total capital. Because what we saw also from New Zealand, in the end we were able to sell the book and bring back the capital. And as such, the net effect there was much smaller than what you think. I mean, sometimes people say, no, go buy a business and then you have instant scale. But the reality is you pay a 20% premium. That 20% premium is already the accumulated loss for most of these ventures. So, I mean, that is a way to think about it.
I mean, were those decisions hard to make, given the people impacted and the like?
No, it wasn't that hard. I mean, we take a very human approach, and I mean, most of the people we were able to redeploy elsewhere in our business, and it helps that you're a growing business. So when you're a growing business and you have to close something down, you can quickly shift people to another area most of the time.
I mean, if you look over the next few years, any of these kind of current new ventures you're investing in that you're particularly excited about, that you think could be quite meaningful on the group level down the line?
Yeah, I think, as I said, the low market share is our opportunity. So it's not necessarily just the new ventures. It's the ones where our share of market is lower than what we think it could be. That really excites us. And it takes a different type of person. I mean, some people, they want to start things and they want to do new deals, and they almost in the instant gratification bucket. I mean, we're a special type of breed who's willing to watch sales reports for 20 years and get excited every night when you see it's going well. Awesome. So it takes a special type of animal, but the reward is really good, and if it makes you happy, it's great.
Yeah, that's awesome. And then maybe onto Ireland a little bit. Tell us about the interesting challenges or joys of going to a new market now at kind of almost 20 years, more than 20 years in.
Yeah, it's excellent for a number of reasons. One, it actually enabled us to deepen the depth of talent in our business, because it created new opportunities for some key people to find new roles. We had a few people who immigrated who loved the company, but they wanted to immigrate. When they heard we're there, I mean, the lines were buzzing and said, but we want to come back to OUTsurance. And if you look at our system development, a lot of the stuff is happening in Ireland, and because they're 100% on the new platform already, so they're leading the way in some of the areas. So I think that's been really great, but also to see how fast you can move if you don't have a legacy system, or, I mean, having millions of existing clients is great, but it does slow you down because you have to work with more care in a lot of areas. Whereas if you don't have many clients yet, you can shift much quicker.
I mean, you spoke earlier about how important it is picking the right country where your existing playbook would work quite well. Has that worked out to be the case, where a lot of the SA and the Australian recipe fitted quite well for that market?
I mean, we sort of have 2 years of trading history now, and so far, I mean, the business case is working out for us. So all those sort of assumptions now should should work is playing out as expected.
Okay. Marthinus, capital allocation is a key focus area for us as investors. Walk us through your decision-making framework when a new idea lands on your desk, whether it's a new business line or a new country. How do you guys think about whether to go for it?
Yeah, I think a key thing for us is it must make the hurdle rate, and it must be realistic. I mean, if you work through the thing and it's got a lot of very airy-fairy assumptions, you want to be able to verify a lot of those assumptions with actual experience you've seen elsewhere. I think that's really important. Hurdle rate, and as I said, not betting the farm, and I mean, will you cause reputational damage if you have to reverse that decision? So I think that those are some of the considerations. But capital allocation is not just sort of starting brand new businesses always. I mean, for us, I mean, some good examples of very good capital allocation is where we bought the previous founders out of Youi. If you look at what we paid there versus how it's grown since then, it's been a great capital allocation. And incremental investment in growth or distribution and those things, our outbrokers, I mean, that was a really good sort of internal allocation, and it's delivering now.
So Marthinus, throughout your career, or maybe even before OUTsurance and during your time here, are there any people that stand out that's made a key kind of impact on you and how you see the world and how you run the business now?
Yeah, that's a good one. I'll try and tackle it a bit sort of in chronological order, because I mean there's a lot of people who helped to shape you over the years. So probably the first one was Professor Marx at Tux, where he sort of had short-term insurance there and gave exposure to that at a very, very early age or stage in the degree. So that was good. At my first employer, I can probably single out Roger Grobler and Rob Ward. I mean, they really helped me gain some technical skills in pricing and underwriting, and I also learned the importance of pricing discipline at quite an early age. And as I say, in the land of the blind, one eye is king. And I think because those techniques were so new back then, if you can apply them, that definitely, and you had the data to do that, it gave you a competitive edge. So I think that was really, really important. When I arrived at OUTsurance, obviously Willem Roos, one of the founders, and I think what I really learned from him was sort of also to look at the wider business, where you can apply actuarial skills, understanding of numbers. He's really good with that. I think that was a key learning. And then the data discipline. He certainly laid the foundation at OUTsurance in terms of that data discipline. And I think it's only, I mean, if you look at other places and some of the challenges, that you appreciate that what that meant, that good data discipline from day one. Then Howard Aaron, who was one of our other founding members, he developed sort of our first core systems, and I think he really showed what agile development really meant. I mean, I know it's a very overused phrase that perfect is the enemy of good, but if you look back now, many of those good solutions are still in use 25 years later, and that's why it's so important. Just sometimes you must just do it. So I learned a lot from him. I think I also have to single out Laurie Dippenaar, who was our chair, and who really sort of approved our business case for being willing to back such a young group of guys. I mean, Willem was 26, I was 24. So been willing to back us, and he was a great board member and chair for more than 20 years. Always extremely well prepared, asking great questions. So I really have to single him out. And then our boards. I mean, we have great boards in Ireland and Australia and South Africa, and you have people working across industries. You learn a lot from them. But again, if I have to single someone out there, then Campbell Korf, who used to be our chairman at Youi. I learned the most from him on leadership. And he worked in various markets. He worked in the US, in the UK, Southeast Asia, and Australia. And I certainly think if you work across many markets and you read a lot, it certainly widens your perspectives. I learned a great deal from him. And then lastly, and it's funny, sometimes people think you can only learn, or you mostly learn from older people or more experienced people, but I learned so much from my team. Most of them are younger, fresher than me, and less experienced, but you learn so much from them, and specifically our sort of group Stratco, of group Exco members, I learned a great deal from them over the years. And we, as I said, we work together across time zones, long hours, but it's through solving problems that you learn.
Look, I think that's great to hear, because I certainly think in many companies there's the case where most people don't want to give the CEO criticism or advice that he doesn't already believe in, but it sounds like it doesn't work that way. Yeah.
No, that's not our culture.
Yeah, that's fantastic. If you look through out over the next decade or so, what are the key things you think will change around the industry and the key parts of the business you're excited about?
Yeah, I mean, we spoke about self-driving cars, technology. I mean, AI is a technology, but we don't like to get bogged down by that too much, because we view those things as tools, and we've always used the best and most recent tools to deliver on the things that clients really need. So that just helps with execution. So we're not concerned, and we're also not building a strategy around a specific technology tool. We've seen some of the insurtechs trying to do that, and none of them have really disrupted or gained huge scale. So in the end, you're an insurance company. You must just use the tech to be the best possible insurance company you can be. And I think in that regard, look at a Progressive in the US. They pioneered many things. One of the first to use GLMs, telematics, credit pricing. There's quite a long list of that. And that's also why we're not ashamed to copy someone else if we see they've got a good idea. I think that's quite important. But in terms of risks, if you obviously as a big company you have many risk meetings, and you have to think about the risk. I think the big risks which always at the top of your risk registers, cyber is right up there. Climate change is absolutely up there, and regulatory changes, they're also right up there. And I think if you can navigate those very well and manage them in a way that you continue to deliver on the expectations of your target market in terms of competitive prices and good service, then I think you'll always have a business.
Anything on the other side of this? Anything that will keep you up at night, or that you specifically worry about over the medium term?
Yeah, I think other than those things, not so much. I think insurance is always going to be needed. Whether it's individuals or small businesses, they need insurance to allow them to focus on their core businesses. And as such, I don't think we're a business or an industry that's going to go out of fashion. And you look at, as I say, you look at things like climate change, urbanization. The mix in the business might change over time, but the principles is probably still the same.
Yeah. Marthinus, some of our listeners are current or future or potential investors in OUTsurance. anything else we haven't touched on that you think is important for them to think about or to understand looking at OUTsurance?
Yes, I think something to think about or to understand for investors. There's probably two things which stand out for me. Is one is our long-term focus here. As I said, we've created this great compounding and great return, but you need these really long J curves, and investors need to understand that the payback for these things is really beyond 10 years. You do well to break even in 5, beyond 10, the payback comes. And then I think the other very important one is just we have a sort of a reasonable appetite for volatility. And that's the nature of the business, because we've seen in some other insurance businesses that sometimes if management is not long-term focused and they don't have a reasonable appetite for volatility, then some sub-economical solutions are put in place just to sort of smooth earnings. And we don't do that. So, I mean, some people might put in some funny reinsurance structures, and then it ends up costing you a lot of money. So long-term investors who invest in us, they must understand through the cycles that we're disciplined. Since we reached break-even, we've never made an underwriting loss in a single year. And again, as Progressive says, they say in the Jim Collins book, they say there's no excuse for not making an underwriting profit, and it is really true. So if investors can just get that understanding of the long-term nature and focus and the reasonable appetite for volatility, because sometimes, I mean, at the half-year results, if you now suddenly have 2 catastrophes in November, the half-year results might be a bit depressed, but then when you get to full year, it's already evened out. Sorry. And then if you look at the 5-year view, it's absolutely not a problem.
I mean, from our perspective, clearly Australia has some more natural peril volatility. But then if I look at your SA business, this might be the most stable short-term insurer in the world, right? I mean, it's been unbelievably I think, stable in terms of claims ratio and underwriting margins.
And it depends on the mix of your perils. So vehicle accidents, damage, repairing the car, and vehicle theft are highly predictable. And that's why in South Africa we cover geysers in people's houses. I mean, those frequencies are predictable in a very, very narrow band. And that accounts for a very large portion of the South African claims. In other markets where natural perils might be a bigger portion of the claims, you have more volatility on that. And then in markets where bodily injury is covered, sometimes you do get changes in economic variables and you have to change assumptions. It's a bit more like a life business where your reserves change. And then it also might affect your earnings too. So South Africa is a bit of a special case in that we don't have long tail business, and the short tail business is mostly damage, is man-made sort of losses, which is highly predictable.
I mean, you touched on the J curves you see in new markets, but I think it's interesting from an investor perspective. You guys have done a really good job communicating that to investors, also setting the 10% framework for roughly where you expect to operate during the times. And I guess what gives one comfort on a new business like Ireland is you kind of really accurately predicted almost what to expect over the first few years, and it seems to have largely gone in line with that so far.
Absolutely. I mean, that boils down to our appetite. As we said, on an annual basis, that 10% of operating profit of the in-force businesses. And in terms of Ireland, initially we guided sort of that in terms of accumulated loss, we thinking around 1/4 operating profit of the group. And we still comfortable with that. And that doesn't imply betting the farm.
So Marthinus, we plan to end every episode with a conviction card, and this is one thing you've got high conviction on for the next decade. And it can be about your business, the world, the economy, politics, anything you want.
Yeah, I think what I like is it's an interesting one because we love being listed. It's certainly it brings a bit of an extra focus, capital discipline, governance, and even autonomy to the business. But I mean, I think the risk there in being listed can be that you can become short-term focused and that your appetite for volatility becomes too low. And so the challenge almost, or my conviction card for investors is just every time there's a big natural peril event, I see people selling off short-term insurers' shares and the shares dive. And then I think to myself, but what's the reasoning there? I mean, it can only be that you're short-term focused, because if you strictly think about our business fundamentally, I mean, if there's no claims, we don't have a right to charge premium. Think about self-driving cars. If it shrinks the market, if there's no claims, the market shrinks. So if there's no natural events, the market's going to shrink. The converse is true. Every time there's a big natural disaster, what does that mean? Long-term growth. think about it that way. I mean, in the end, we pay claims and we put a markup on top of it for your overheads and your cost of capital. I mean, OUTsurance is really well placed with that, given our strong pricing power. So the next time, I mean, there's a big natural peril event, I actually want people to think about it, because this is pro long-term growth, and you need to ask yourself, am I a short-term investor or a long-term investor? And how you react to that will probably tell you which one you are.
And I think meeting you over the years, I think this is the single best thing you've taught me over the years, is thinking about it in that framework, that the model is really adding a margin on claims and serving customers that way. So one shouldn't be scared. It's most likely a good thing that there's claims out there, and I think it's a fantastic way of thinking about it.
Excellent. I mean, we even get questions like, sort of, there's these predictions of a very severe El Nino coming up, and what's the impact on your business? And I think, again, you need to think around this. While it's not perfectly correlated, it's sort of loosely correlated, unless you now obviously do crop insurance. But if you think about the property classes, generally in El Nino periods, profitability is higher, but that's negative for growth because of my previous point I made. But the converse is true about La Nina. You get high natural perils, storms, floods, bad for profits in the short term, great for growth and profits in the long term. So that's maybe just a way to think about these things.
Awesome. Well, thank you very much for the conversation, Marthinus, and I really appreciate your time. I learned a lot, and it was fantastic to chat.
Thanks, Jock. Thanks for the opportunity.
Peregrine Capital's funds may hold positions in companies discussed in this podcast. Today's conversation is for information only. Nothing you hear is financial, investment, legal, or tax advice.